When a sovereign nation runs completely out of money, when the banks freeze, international trade halts, and the government cannot pay its workers, there is only one number they can dial. They call the International Financial Emergency Room, the IMF. We saw the desperation of this exact scenario recently in Sri Lanka and a few years earlier in Greece. Total national bankruptcy leads to critical shortages of imported food and fuel, sparking massive social unrest. Now, if a developing nation isn't bankrupt, but instead needs a massive injection of long-term capital to build a new power grid, highways, or hospitals, they make a different call. They go to the World Bank. Because both of these institutions serve around 190 member nations, they project a specific image. From the outside, they look and sound like the United Nations General Assembly, a cooperative, democratic body where the global community sits at a round table to solve economic problems. That image is an illusion. These institutions operate exactly like corporate boardrooms. A handful of wealthy Western nations hold a legally hard-coded monopoly over the financial fate of billions of people. To understand how this works, we have to look at the math. The International Monetary Fund acts as a lender of last resort, providing short-term bailout cash, while the World Bank issues long-term construction and development loans. But neither operates on a one-country, one-vote system. Instead, they use a quota system. In plain terms, votes are bought. Your voting power is directly proportional to the size of your economy and financial contribution. This chart maps population against voting power. Developing nations hold the vast majority of humans, but a tiny fraction of votes. The US alone holds roughly 17% of shares. Because major decisions require an 85% supermajority, passing anything without American approval is mathematically impossible. The mathematical architecture of the system ensures American control remains permanent. Western supremacy is hard-coded into the arithmetic of global finance. That mathematical dominance originated in 1944 at Bretton Woods, where the Allied victors of World War II designed the modern financial system. From that meeting came a strict gentleman's agreement that still locks the Global South out of executive power today. By convention, the managing director of the IMF is always European. The president of the World Bank is always American. This unwritten rule has been challenged for decades, but it has never been broken. For the countries actually borrowing the money, this Western control translates into brutal realities. Every IMF disbursement carries a specific price tag in the form of strict policy demands, known as structural adjustments or conditionality. To get the money, desperate nations are forced into a specific economic mold, heavily favored by the West, often called the Washington Consensus. They must enact severe fiscal austerity by slashing government spending, privatize state-owned assets, and forcefully open their markets to foreign competition. These policies frequently trigger intense domestic backlash. Critics point to long histories of deep recessions in borrowing nations like Argentina, arguing that austerity measures balance the national spreadsheets by cutting essential services for the absolute poorest citizens. The people forced to endure the deepest cuts to their hospitals, schools, and wages are the very same populations who lack the mathematical voting power to change the boardroom dictating their suffering. After decades of enduring grueling austerity cycles and debt restructuring traps, the developing world reached a breaking point. They began actively searching for an exit from the Western monopoly. With more than 40 low-income countries facing severe debt distress in 2026, this structural imbalance has evolved into a strategic vulnerability that rival powers are now moving to exploit. China directly challenged the World Bank by establishing the Asian Infrastructure Investment Bank and subsequently launching the massive Belt and Road Initiative. They found a highly receptive audience by offering an irresistible competitive advantage. China provides massive development loans to over 100 different countries without demanding painful IMF-style policy conditions in return. Simultaneously, the rapidly expanding BRICS coalition, now including major economies across the Middle East and Africa, is actively pushing for structural IMF reform while designing alternative international payment systems entirely insulated from the US dollar. The traditional power brokers are now facing an existential choice. As global debt peaks to record highs, The Western Board of Directors must either surrender a meaningful portion of their voting shares to the Global South or watch their historic monopoly fracture into a divided, dual-track global economy.